the Federal Reserve has taken the low interest rate punch bowl away from the housing party. Does this mean that the housing market is about to crash just like it did in 2008? Well, I don't think so, but let's take a look at exactly why it's going to be different this time and how it's going to be different. Starting up, the Case-Shiller Home Price Index is at all-time highs, but this index only tracks sales of existing construction. New construction is excluded, and, well, it lags behind by about 2 months, so the data isn't necessarily the newest. But looking at the chart, prices are high, and that isn't a surprise to anybody who's been paying attention. If you don't live under a rock, you know that housing has exploded. But how affordable are those houses? Well, the Fred database says that the mortgage debt payments as a percentage of disposable personal income are reasonable. Just look at this chart and compare today in the chart to the 1990s or the pre-2008 crash. Now, this chart is updated quarterly, so this particular chart is from October of 2021, as the latest numbers, they're just not out yet. But this chart is extremely misleading to me. Why? Well, let's look at this other chart. Let's look at the chart of the average home price to median household income ratio in the U.S. It is at all-time highs. Historically, the average house in the United States costs 5 times the yearly income. It was barely above 7 in 2006, and, well, that led to the 2008 bubble. And now, well, we're almost up to 8. The average house is almost 8 times the average income. It's tremendous, right? According to Fred, disposable incomes are higher than in the 2008 bubble. But wait, this chart doesn't factor in inflation. The real disposable personal income does. And in that chart, we can see that those incomes are declining due to inflation. Real incomes are actually going down because of inflation. So houses are more expensive than in 2008, and incomes are shrinking. This chart shows the percentage of changes in home prices and incomes adjusted for inflation. They line up pretty well in the U.S. We're pretty maxed out, but they're crazy high in Canada. Canada is set for a housing market bubble bursting. What does this all mean? Well, the typical home in the U.S. now costs 1/3 of the typical American income. That's the largest it's been since 2007. And that's up 24% since the end of 2021. So houses are expensive, and consumers don't have much more money to spend on those houses. This should indicate a 2008 style crash, right? Well, not so fast. Credit standards are higher today than back in 2008 during the housing bubble. And we don't have adjustable rate mortgages or ARMs on the same scale as they were back in 2008 when they were big. Make no mistake about it, the interest rate increases by the Federal Reserve, they will slow demand for both new housing and for refinancing of housing. But that doesn't mean that we will see people walk away from those houses like they did in 2008, or that there'll be tons of foreclosures due to ARMs adjusting up and people not being able to sell those second and third investment homes. Keep in mind, when the 2008 bubble burst, it took about 3 years for the market to bottom out on housing prices on the scale, and even longer for the delinquency rate to catch up, and that was without a moratorium. Real estate has major lag behind the rest of the economy, and people might be house poor, but they're not behind on their payments. Listen, you might see headlines about foreclosure filings going up by some large percentage, 38, 39%. And that's technically true, but it's totally misleading. Let's look at why. Here's what the chart looks like. We had a moratorium on foreclosures because of COVID, and that sent the foreclosure rate down to one of the lowest levels that we've ever seen in modern times. But now virtually all the moratoriums on foreclosures have ended nationwide at the state level and the federal levels. So yeah, there is some foreclosure demand that's pent up, and that's offset just a little bit by the payment assistance programs we've seen from the federal government. But looking at this chart closely, we can see that even the increase hasn't taken us back up to levels from back in 2019. So foreclosures are increasing, and they'll continue to increase, but that is just us returning back to normal levels. We aren't even back up to the foreclosure levels from 2005, which they were considered boom times in housing. This is before the bubble started to burst. The rate of home ownership isn't even back up to the historical average. Look at the chart. It's down. And according to the Fred blog, the spike is from people moving into houses to get away from COVID. And the dip after, well, that is when people return to multifamily housing in some fashion as we kind of return to normal from the COVID environment. But the millennials are the largest group in the housing market today, and many of them have yet to purchase a house. That is why the average home ownership rate is below the historical average. And at the same time, the completed housing units, they haven't caught back up to the average. In the wake of 2008, construction slowed down. Builders have been authorized to build many new housing units, but they have not yet started them. So there is still pent-up demand in the housing market. We had overbuilding and easy credit in 2008, and that was followed by underbuilding as the Great Recession occurred. And now we have higher demand from COVID and millennials entering the market. While older folks, they've decided to stay in their homes just a little bit longer because of COVID, as opposed to moving to apartments or multifamily retirement communities as they traditionally do when they age out of single-family homes. So I think we'll see demand start to slow as affordability is impacted by higher interest rates, and we'll start to see the high max payments as the percentage of incomes that lenders will lend at start to be a crunch on the upper cap of housing prices. But absent a major economic crash that causes mass unemployment, we won't see a 2008 style housing crash. Compared to 2008, prices will have a slow burn down, and people will be house poor. Yes, they'll be house poor. And yes, mortgage loan officers and construction companies will have layoffs during the upcoming recession, as we've already seen start in the mortgage industry recently, as refinancing has collapsed. But this won't be as bad as the 2008 housing crash. What do you think? Tell me in the comments below what you think will happen next in the economic circus.